And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. If Bitcoin is digital gold, well, why isn't gold like a physical Bitcoin? Let's talk gold with two of the world's great authorities on gold. George Milling-Stanley is the chief gold strategist at State Street Global Advisors. He oversees the Spider Gold Trust. Gold Shares, GLD, that's the world's largest gold ETF. Will Rind is the founder and CEO of Granite Shares, which oversees the Granite Shares Gold Shares. That's BAR symbol. George, I know gold is considered a hedge against inflation, but if that's the case, tell me why gold isn't higher this year. People have been asking me this. We're now seeing notable inflation, but gold is down this year and about where it was 10 years ago.
Bob, I think that the truth about gold's relationship with inflation needs to be kind of carefully phrased here. Gold is a very good preserver of purchasing power during periods of sustained high inflation, such as we had during the 1970s, for example. What we have right now, when inflation has been above 5% a year for a period of months or years, as it was in the 70s, then gold has given you capital appreciation equivalent to 16% a year. So a real rate of return of better than 10%. That's really pretty good for an asset that doesn't have a yield. What we have right now, we've had inflation around 5% for 3 or 4 months, and everybody in authority, Mr. Powell, Mrs. Yellen, all telling us that it's transitory, it's not going to last. So I'm not at all surprised that gold has not responded more to the inflationary numbers we're seeing right now. We'd need those numbers for a lot longer period before we get a meaningful response in the gold price.
And Will, can you follow up on that a bit? Is it possible gold is also bought for reasons other than inflation? There's all sorts of reasons to buy gold at this point, not just inflation, right?
Yeah, that's absolutely right. I mean, there are a number of ways, a number of reasons to buy gold. But just to riff off of what George just said, I think, put simply, the market doesn't believe we have an inflation problem at the moment. And I think you're only going to see a big response from gold at the point where we acknowledge there is a problem with inflation. And at that point, then the list of places to hide, so to speak, will not be very large. And gold is certainly going to be one of those places that people go to. But I think at the moment, the reason why gold isn't materially higher, despite the fact that we have high inflation numbers, the highest numbers that we've got since the 70s, is the fact that we don't have a problem in the official eyes of the Federal Reserve and other market commentators. That is the reason why we can still have stock markets at all-time highs.
Yeah. Will, I want to pick up on this digital gold idea. It's commonly said Bitcoin is digital gold, but is it, or is that just some phrase that we've all adopted now and sort of half believe? Is it really a threat to gold? And is there any evidence that gold, that Bitcoin is taking or siphoning investment dollars away from gold?
It's really difficult to say, to your point about the evidence of that. I mean, for sure, of course, with the market cap of Bitcoin and other cryptocurrencies, absolutely they are attracting capital. They're attracting lots of capital. To the extent that they're attracting capital away from the gold market, though, I don't know. I'm sure there's some of that going on, but I don't think it's perhaps as big as some of the commentators might say. To me, it's two very different states. The reason why people are buying Bitcoin and cryptocurrencies at the moment is highly speculative. That's a complete risk-on situation. And you can see that where you have the big drops, obviously in those cryptocurrencies, volatility spikes, it's less defensive in my mind. The reason why people are buying gold at this point is much more defensive. It's around the inflation story. It's around the long-term preservation of capital and purchasing power. And to me, those are just fundamentally different states right now.
Yeah. George, I think, he's onto something, Will, here. I mean, gold is bought to reduce risk, isn't it? I mean, it seems like crypto is a big risk. Crypto is how many times more volatile than gold is? 5, 6, 7, 8 times. In terms of volatility, it's a completely different asset class, right?
Completely different. I think Will's put his finger on part of the big difference here between the two, and the reason why I think it is quite possible for these two assets to coexist quite happily in the market, because they do completely different jobs. If you think about it, the contribution that cryptocurrencies just to finish your question, we've had Bitcoin for about 12 years, and over that period, it has been almost 10 times more volatile than gold. And you and I have both heard over the years people complaining that gold's a volatile asset. Well, cryptos are much more volatile. But the contribution that cryptos make to portfolio performance is entirely based on their returns. And as we all know, returns can be positive, which is wonderful, or they can be negative, which isn't so good. The historical promise of gold to investors has always been twofold. One, that over the long term, and I stress this, over the long term, gold can improve your returns, and it can also help to reduce your volatility. Cryptos, as I say, are increasing the volatility. So gold can actually make a contribution toward improving the Sharpe ratio of a portfolio, which obviously has to be the holy grail of any asset allocator.
Yeah, and the Sharpe ratio, of course, is how well that asset or that stock or asset does compared to the overall market. George, bring us up to date on global.
Does it improve your risk-adjusted returns, Bob?
Right, risk-adjusted. Thank you. Yes, risk-adjusted is correct. George, bring us up to date on global gold demand. Now, I mean, we always think of gold as jewelry, and I guess about half of gold demand worldwide is jewelry. Gold. Jewelry demand, I know, slipped last year in the U.S.'s biggest markets, in India, in Turkey, and China. Has it recovered at all?
Yeah, look, jewelry demand typically is anywhere from a half to two-thirds of final consumption in what I would describe as a typical year. 2020, with COVID, obviously not a typical year. Lockdowns, social distancing, all of the issues there meant that gold jewelry consumption fell to about a third of the total when it would more normally have been something closer to two-thirds. We saw the beginning of a recovery in the Q4 statistics for 2020. That recovery has continued. Consumer demand, led by gold jewelry, mostly going into the emerging markets, has done very, very well in the first 3 quarters of this year. And of course, we had Diwali just last week. We're just coming into the big festival season in India, the wedding season in India. For the next 6 months, that is typically the seasonally strongest period for gold demand in India. Looking at the rest of the world, where the Chinese are gearing up for Chinese New Year, not just in mainland China, but in Chinese communities all across Asia and all across the world. And in the West, we're looking forward to Christmas and to New Year, which are also gift-giving occasions. So I think we should be running into what is typically the strongest period for gold demand in terms of jewelry in the year for the next 5 to 6 months. And I think that's part of the reason why gold is where it is today, comfortably above that $1,800 level, which it's found very difficult to surmount during the summer and into the fall. But here we are, wintertime, gold's doing very, very well.
And I wonder if we could put that full screen back up there, because, Will, what I found very interesting, and we've been looking at these for a long time, where the gold is, but only about 15% of the gold supply is held by individuals. We think of people who've got gold bars, or gold coins, or even ETFs, which would include that, and individuals are only about 15% of that. Most of the gold in the world is either in the form of jewelry or in central bank reserves. I always think that's an important thing to remind people about when they think the ETFs rule the world in terms of gold supply. They don't.
Yeah, no, that's absolutely right. But the investor is an important marginal buyer. And so the level of central bank buying has been relatively constant for some time, as indeed has the demand from the jewelry sector. And so that sort of swing amount, if you will, is very much, I think, relevant to the investor. And so in times where you get a lot of investment demand for gold, that does have an important sway, I think, and factor in terms of the gold price. So I think I always view the investor as like the important marginal buyer here.
Yeah, and I think what you're saying is not only is he an important marginal buyer, he actually largely sets the price. It's the gold futures, of course, that really help set the price of gold, and it's those kinds of people who are involved in the futures market and buying things like the ETF that help set the price. So you're right, they're the price setters. And now, Will, you run the Granite Shares Gold Shares ETF, which also holds physical gold like George's GLD. What's your outlook for gold for next year?
Well, I'm very positive on the outlook for gold for next year. And the reason is because of what's going on with the macro environment, and particularly inflation. I think that, the fact that we've held in around this 1,800 level We obviously had the tapering announcement last week, and those that expected the gold price to fall were surprised when it actually mounted a fairly significant rally. And I think that's in a way due to this still, the dovishness coming out of central banks, obviously here in the United States, also in the UK, where there was an expectation by some that rates would rise. So policy remains dovish. And then, inflation numbers, I don't think that these inflation numbers are as transitory as some might think in the market. I think the supply chain issues that we have around the world are not going to resolve themselves as quickly as some might think. And we have real inflationary pressures that if they persist for the longer they persist, the more of a problem that causes, and the more people will look for inflation hedges. And there just aren't that many places to hide. And gold is one of those places that people have always gone to in times of stress. And I think that that is a reason for still believing that gold is going to be there next year if there's an official acknowledgement that inflation is a problem.
And, Will, whenever I do a segment on gold, I always like to remind the viewers that, like all physical gold funds, all physical funds, gold is considered a collectible for tax purposes. And could you just summarize, teaching moment here, what should investors be aware of in terms of the tax consequences of gold?
Yeah, that's a great question. So with a lot of ETFs, I think there's potentially a common misconception that every single ETF is taxed the same. Of course, the tax treatment of an ETF is largely based upon the underlying asset that the ETF owns. So in the case of gold, that's viewed as a collectible, and a collectible attracts a higher rate of tax. It's 28%, as opposed to, say, stocks or bonds, which are targeted at the long-term capital gain rate, which at the moment is quite a bit cheaper, but maybe about to go up. We'll see. But it's important. I think that the history around that is potentially if the IRS thinks you're wealthy enough to own gold or other assets like that, you can maybe pay a bit more tax. But apart from that, it's something to bear in mind.
Yeah. George, the 17th anniversary of the launch of the GLD, which was the first real gold ETF, is coming up. It's November 18th, I believe. So that'll be the 17th anniversary. I remember this date very well because I wanted to have you on with me at the New York Stock Exchange, and I remember you declining because you were concerned that the SEC might object if you made any comments about it. I wonder if we could run this bite of that date and me bringing those gold bars, because you were very helpful with bringing those gold bars onto the floor with me. Let's see if we can run that bite for a moment.
Today, we're going to talk about something totally different. I'm going to talk about this. This is gold. This is a gold bullion bar here. It's 25 pounds. It's worth about $180,000, and I've got 3 of them here, along with a lot smaller amounts of gold, as well as these 2 burly guards I've been married to for the last half hour. Thank you, guys. Why am I talking about gold today? Because finally, a gold ETF is available. Today, for the first time, thanks to the World Gold Council and State Street, you are able to buy gold just like it's a stock.
And that was November 17th, 2004, about 25 feet away. And George, I wish you were there, but you were there in spirit. You helped me get those gold bars on the floor, and I thank you for it. But what a monster it has become in the last 17 years, the GLD.
Oh, it's been an unbelievable ride. I'm amazed at how you don't seem to have changed a bit, Bob, in that 17 years, I have to say. I think I may look a little older than I did then, but that's just the game. If you remember, when you wanted me to come on your show was before we actually had SEC approval to launch. And that was the period when the SEC, of course, insists that we don't say anything to the general public about an ETF until the day that it actually launches and starts trading. That was why I had no choice but to turn you down, although it grieved me desperately to do so. You're an old friend, and I want to keep your friendship. But the moment that I was back in the country, I was traveling back from meetings with investors in Switzerland on the day of the actual launch, and I was on your show just as quickly as the SEC allowed me to be so, which was a matter of weeks after that particular time. You looked really comfortable holding those gold bars, I have to say. And I think it was a great way to open your show. Show people the product. There's nothing quite so bright and shiny as a brand new gold bar.
Yeah, well, not only that, but during that period, gold ETFs were still in the infancy, and it was very important for people to understand that you actually owned something, that you owned you owned stocks that were underlying when you bought the S&P 500. You actually owned physical gold in this case. This was not a gold futures contract. And, today we sort of we talk about spot Bitcoin and Bitcoin futures ETFs, and everybody kind of understands that. Back then, that wasn't so obvious. ETFs were still very much in its infancy, and I'm very proud we were able to make a big deal about that in the beginning and play a part in educating people about about the revolution of exchange traded funds. That's why I have this show, because I believe so much in what ETFs are doing and the power of the ETF structure overall. George, one of the complaints about gold is it doesn't generate any income. It just sits there. But there was a new fund out just recently. The people behind the U.S. Oil Fund, our old friends over there, they just launched the USCF, a United States Commodity Fund Gold Strategy Plus Income Fund. Now, this owns gold, but it also adds a dividend to it, a dividend component, by selling gold call options and then collecting collateral interest income on this. George, and Will too, can you comment on this? Now you get people who are trying to get a little kicker into your ownership of gold.
Yeah, Bob, when I was at the World Gold Council, we were doing our research on GLD back in the year 2000 until we launched in 2004. And one of the things people said to us, the three things they wanted, a product had to be as close a proxy as possible for the physical price of gold, the spot price. It had to be traded on a regulated exchange, preferably the NYSE, where it lists. And it also had to be 100% secure. If you're writing call options against something, there is always the possibility that a rise in price might mean that you are called away and you no longer own your underlying. So I think that this new ETF would not fit the criteria that investors told us they insisted on when we put GLD together back in the early 2000s. That's really the deal here.
That's a very good point. Will, are people deviating from the idea, or does this make sense in a modern way, as long as people understand what exactly George was talking about there?
Yeah, I think it's something that people have always asked for. Gold with income. It's been because obviously the asset does have income. But I think, as George said, it's important to stress that the reason why it doesn't have any income is because gold doesn't have any counterparty or credit risk. The moment you lend gold out, you can introduce an income component, but then you're introducing credit risk or counterparty risk. It's something that gold investors feel very strongly about. What I've always said is if you want to generate income, there are plenty of good ways to generate income. And if you want to have an asset of the highest quality, free from credit and counterparty risk, that's the role that gold plays.
Yeah, good point.
One of the beauties, Bob, of GLD is that there's a very, very deep and liquid options market in GLD. If people want to use options, then they can happily do so themselves. They can generate income by writing calls, knowing that the calls could be covered by their underlying holdings of GLD. And that's really the only ETF that can make that claim.
Yeah. Will, let me get, I just want to switch topics just a little bit. I want to get your thoughts on commodities in general, because you run the Granite Shares Bloomberg Commodity Strategy ETF. That's COMB is the symbol. It owns futures contracts on 24 different commodities. It's been underperforming for years, but now commodities are hot this year. You're outperforming. You want to give a broad view of the commodity market right now for us?
Yeah, that's right. So one of the first years where commodity markets as a whole have outperformed the stock market at large, quite considerably. And so typically, when you get commodities outperforming to such a degree, you've got to ask yourself what's going on. And again, we've talked about some of the issues already on this show, but broadly speaking, this is about years of lack of investment in capital expenditure throughout the entire commodity complex, whether you're talking about the energy complex, whether you're talking about industrial metals or even precious metals. We've had a lack of spending on production, and this is now really combined with this perfect storm of lockdowns, capacity constraints last year, breaking into now a global economy that's reopening, and demand, frankly, outstripping supply for the majority of these commodities. So this has really, caused this, short-term bull market across the board. I think, iron ore is probably one of the only commodities that's actually down this year. But apart from that, there's been a huge amount of interest in the space. Inflation protection from investors is one big part of this, but also people really thinking about longer term. Does this mean that commodities are starting a new super cycle, which obviously could go on potentially for a number of years here?
Yeah, and I want to point out, if we could put that full screen up, about the holdings of the commodity ETF, the COME. This goes back to what I call the politics of indexing. You happen to have 40% in energy. This is not an equal weighted index. So the fact that oil has had such a spectacular move has really helped you outperform this year. Had you only had, 14% what you were in base metals, you have 14%. If that was 14% energy and, precious metals was 40%, you would have done differently. So my point is that a lot of these indexes really do depend on how they are constructed and the particular weightings that are in them, Will.
Yeah, no, absolutely. Same with any index. The interesting thing about this particular index, for example, the Bloomberg Commodity Index, is it's one of the most well-diversified indexes out there. So actually, each individual sector can never be more than a third of the index at rebalance. And so what that means is that it tries to put a cap on sectors so that energy or industrial metals or it can't sort of have an outsized weight in the portfolio like some other indexes in the market. So that just keeps it diversified, because a lot of investors, the reason they're buying is for diversification purposes. They want to put 5% of the portfolio, 10% of the portfolio, and they just want a controlled, diversified way to do that. And I think that, COMB, ticks those boxes for those that are looking to invest.
Yeah. All right, gentlemen, I'm going to have to leave it there. George, I look forward to the 20th anniversary of GLD so we can show more old pictures of myself. And you'll be around, I'm sure, at that point. I appreciate your contributions over the years to helping us understand the gold business. Now, that does it for this week's ETF. And again, thanks to George and to Will, of course. We've asked Will to stick around and talk about his large cap ETF that tries to exclude losing stocks for the year for our ETF podcast. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.